Zu Gast hier am Institutional Money Kongress ist Professor Raghuram Rajan. Er ist Finance Professor an der Universität von Chicago und war von 2013 bis 2016 Präsident der indischen Notenbank. Raghu, thank you for being with us. Your presentation here at the Congress, you gave it a title, The Global Outlook. What were your main topics?
Well, I think I emphasized the strength of the global economy today with all the engines firing. Europe, of course, is the most recent sort of engine which has started last year and looks very strong right now. The US has been going quite strongly for now close to 10 years. And of course, China has been slowing, but slowing at a gradual pace. So for the first time, the real side looks very good, which then leads to the question, what's the problem? And that's the other side that I wanted to talk about also, that the financial side has been stretched for quite some time. And so we have the positive of strong growth and the potential negative of financial fragilities that might have built up over these 10 years.
Until end of January, everyone was optimistic regarding economic growth and financial markets. Then came the correction in the financial markets. Did that confuse you or disturb you in your view ahead into 2018 and beyond?
No, I think it would be good if financial markets readjusted to the reality that interest rates are going up. That doesn't necessarily mean the end of the expansion. That to some extent the central banks are less willing today to support the real economy because they feel they've done what they could, and certainly they don't want to support the stock market, which they were in the past because growth was very fragile. So I think it's important for the financial sector to realize interest rates are going up, but also the put option that central banks gave is no longer so easily available, that if the stock market falls, central banks aren't going to come in with a lot of support.
I think the role of central banks is very important for the financial markets. There is Jerome Powell, who has his first congressional hearing today. Do you think that with him at the head of the Federal Reserve, there will be, we have to expect some changes, especially because he's not the only one who is who has been replaced?
Well, I think that Governor Powell and now Chairman Powell has been in the Fed for quite some time and is somebody who's known as a consensus builder. And certainly he's been part of the consensus at the Fed with Janet Yellen. So he sort of knows what the Fed is trying to do, and I presume that he is fully signed on into that process. One person, of course, doesn't change what the Fed does, and especially one person coming up from governorship to chairmanship. Everybody knows them. They're not going to change what the Fed does overnight. I think over time he will stamp his impact on the Fed, and we need to wait and see what that is. But I think in the short run it will be continuity.
Let's suppose that there will be 3 or 4 rate hikes in the US. Can Europe and other countries, other central banks like the ECB or the BOJ, what can they do, and can they stay in their course of not hiking yet?
Well, I think they, at this point, both the ECB and the BOJ want to see still stronger growth across. In the euro area, it is growth across the center and the periphery. And in Japan, it is to see inflation coming back finally. So I think till they feel more confident about that, they will restrain themselves from talking about the end of monetary easing. But it is important to note that the Fed moving out gives them more room, because as the Fed raises interest rates, some of the pressure on their currency to appreciate will get alleviated somewhat, because the interest rate differential will then become more attractive for investors to put their money in dollars. So I think it's important, as the Fed feels comfortable the recovery is still proceeding, for the Fed to continue raising interest rates. And that will allow the others more room to eventually come out of their process of accommodation. Of course, as as markets sense that they're removing accommodation, exchange rates will strengthen, but that's a natural process. One shouldn't worry too much about that. They'll wait as long as they need to and then start that process.
Let's have a closer look to Europe. Can a country like Italy at all sustain rate hikes if we take into account the indebtedness, the high indebtedness of a country like Italy?
Well, whatever the indebtedness, really, it is important that your interest rates, your nominal interest rates, not be much higher than the nominal growth rate. Otherwise, you have very little room. And today, they're about even in Italy. So it is very important that they increase their growth rate. And that requires a continuation of the reform process so that their costs, for example, wage costs, come down. They get more wage flexibility. That process was begun in 2014, but a new government will need to take it to its logical conclusion. So I think the election next month matters a lot. And if they get the right sort of combination, then they can perhaps make the changes that are needed to put some of these issues behind. The problem, of course, is the longer you stay in relatively low growth, the more the population becomes averse to reforms. And that becomes a downward spiral. So it is important that when Europe is growing strongly and there is a little bit of a tailwind behind Italy, that they have the political sort of support to make the changes that they need to.
In 2005, you were at the International Monetary Fund, the chief economist. You predicted something like the financial crisis, which occurred 2 or 3 years later. So if we look now into 2020, 21, 2 years from now, what could be the next trigger of a perhaps financial crisis then?
Well, as you say, on the one hand, those who forget history are condemned to repeat it, and on the other hand, history never quite repeats itself, but it may rhyme, right? To some extent, I think we've solved some of the old problems. The extent of banking leverage, for example, is far lower now than it used to be. But of course, the system as a whole takes risk. And if you reduce the risk in one part of the system, it migrates elsewhere. What we need to understand better is the risk in the rest of the system. Is it borne by the right entities, or has it gone to the wrong places? This is why I think some of these short-term volatility that we saw in the beginning of this month is good, because it's sort of stress testing the system. And if they get, if we see a few more episodes, we'll have a better understanding of what the fragilities are. For example, this one wiped out the ETFs that were essentially shorting volatility. And given that, maybe that's a good thing that it happened before these things became really big and systematic. I think what we need to do is certainly look at the places where risks potentially are being borne and check if they're large enough to be worrisome. For example, cryptocurrencies. $330 billion worth of cryptocurrencies. Remember, the subprime was 100 billion and it took down the entire system. So we can't be sanguine about some of these areas. And I think I wouldn't say advocate immediate and large regulation, but I think we need to watch all these areas very carefully and make sure somebody is looking at them.
Thank you very much. It was a pleasure to have you here. Thank you very much for being with us. Thanks.